We are live. Welcome to the Portfolio Builder Premium webinar. Today is October 29th. A lot to cover. Let's go ahead and jump right in. This is starting off with a slide about our high risk, high return strategy. Now up a blistering 314% year to date, outperforming the S&P 500 20 times. So if we look at all of our strategies, we do offer some less risky strategies. We are able to control risk by going after larger or smaller markets. So the smallest market we're targeting is in the high risk, high return portfolio. So in total, you've got about $3 trillion worth of total assets stored in the key assets behind high risk strategy. It's now up 33% in October. And that's going to be a big play on oil and gas to hedge against inflation, in rare earth metals to hedge against supply chain issues for companies like Apple and Tesla, betting big on lithium and cobalt, and then playing the hottest growth asset, which I would say is by far Ethereum, which is a lot like investing in Microsoft early on. Now they have some competitors that you might consider hedging against, but that's how we've been making just massive gains this year with a very concentrated bet in those three assets. Now in the Safe Alpha portfolio, we're up 19% year to date, still seeing US markets kick the ass of foreign markets. This is our Warren Buffett strategy. Now, if you're familiar with Berkshire Hathaway's asset allocation, massive bet on Apple, and then he hedges the growth position, which is Apple, with massive positions in banks and insurance companies. Now, banks and insurance companies love it when there's a recovery in the economy and rising interest rates. So that's the way Buffett plays it. We're similar. We have the entire NASDAQ leveraged times 3 with the triple Q in the Safe Alpha. And then we're going to a better value play, in my opinion, that can really outperform banks in an inflationary environment. And that's betting big on the oil and gas play. So that's done tremendously well. ExxonMobil just came out with earnings, beat expectations. We're about to have an epic energy crisis this winter. So if you're wondering if you should be selling your NRGU, hell no, hold on to your horses. We're just getting into the cold months. People are having to switch from natural gas to oil, all kinds of problems coming down the pipeline there, which is being exaggerated due to local policies to shut down our own supply of oil. In fact, the US is about to run out of oil and make that price go up even higher. Okay, so the next product we have is the Safe Growth Pro. This was up as much as 16.5% earlier this week. It has pulled back a little bit. We're seeing weakness in emerging markets and in that oil and gas play because of Asia. But again, this is all short-term noise. Long term, I think you're going to have a very hard time outperforming the pro strategy in the coming decade. That's because I do see European stocks and Asian stocks outperforming US stocks due to big stimulus coming through. Now, it's been a long time to get stimulus through. We're weeks away from closing in on a deal. And that's what typically gives foreign continents an advantage to US markets, because it weakens that dollar and then really provides huge headwinds for the pro strategy. We call that the Ray Dalio strategy. Now in the Safe Alpha with Warren Buffett, you're playing the tech sector and the energy sector with the bulk of your capital. So in total, you're looking at around a $20 trillion market. If we go to Safe Growth Pro, now we're playing the global stock market. This is where the super rich have their money spread out. It's over a $122 trillion market cap. Now, if you want a combination of Ray Dalio and Warren Buffett with a edgy position in Bitcoin, that's where your Bootcamp core portfolio comes in. You're betting big on tech, but with a special ETF that has smoked the triple Q. It has some exposure to China and the top US companies. We've got a huge oil and gas hedge, plus we have a big Bitcoin position. So that's what our Bootcamp core portfolio offers, up 23% in October. Now, if you're on a free trial, you're only going to see the high risk, high return strategy. The second you upgrade, you're going to gain access to our membership area where there's a risk calculator. You punch in how much money you want to invest into each strategy, and it tells you exactly what to buy. And the second you order, My father, Victor Cox, is going to give you a 1 hour walk through the entire membership area. Okay, people love this initial walkthrough, and they realize they now have all the power in their hands to finally control their financial future. Now we're getting through earnings this week on all the big FANG stocks, and we're slowly entering the stock buyback mania to close out the year. So I'm anticipating a market melt up dead ahead. Only thing that's going to give this trouble is not passing the stimulus, and maybe the market gets a little upset when Powell presumably begins tapering quantitative easing on Wednesday. So we'll keep close eye on that. We might increase our hedging strategy on Tuesday slightly ahead of the announcement that we're anticipating on Wednesday. Now, he may kick the can to December, which markets would certainly like. So we'll see how this plays out next week. We made no trade alert this week and have just recommended a buy, red hot trade alert. All 4 strategies are perfectly positioned for what comes next. Now, at the end of this video, after covering charts, data, and news, we will review our exact trading formulas for each strategy, and that's going to reveal precisely how to invest your money safely. Now, if you don't want to miss the next trade alert or you'd like a walkthrough, I highly recommend you call John at 505-610-1334. He will take your phone call through the weekend. So give him a ring. He can walk you through the full trading plan. He has his own money behind this. And I think you're going to really enjoy a nice conversation with John. More importantly, he can sign you up, give you a special deal, and then we can schedule your walkthrough with Victor Cox Monday morning. So don't miss out. Call John at 505-610-1334. Okay, stocks, cryptos, and most importantly, commodities are likely to melt up all the way until mid-November. That's when I think the market's going to start getting really pissed off if Jayapal and Joe Manchin cannot close a deal. So Pelosi's getting smacked around by Jayapal. There was rumors they're going to pass a deal Thursday. It looked like the progressives had folded their hand, given up the opportunity for Jayapal to become the leader of the Democratic House. And boy, oh boy, that was fake news. She shut that down, kicked her out of the meeting Thursday, and they did not put the vote up. So we'll see how this progresses into next week. If Biden's Build Back Better plan is passed, the market could melt up all the way into March, maybe a little bit past March. After that, we're going to need more stimulus or a blistering labor market recovery. And so I think it's going to be difficult to pass more stimulus after this deal is pushed through. And Biden policies so far have been disappointing on labor market recovery. If you listen to Pelosi pitch the Build Back Better deal, what does she say? Parents get paid and children get education. It was a little more catchy, and she's promising 7.5 million jobs with the light version of the Build Back Better. With the heavy Build Back Better, she's promising 20 million jobs, which is almost hysterical. But either way, we watch that data on a daily basis. So we're ready for it. Failure to pass the budget will result in another debt ceiling crisis by December 4th, and we will get volatility in stocks. Okay, the global economy completely relies on the US government issuing debt every year, and it has to slowly but surely increase that debt to keep everything humming along. We're now at a debt to GDP in the United States well over 100%, which means the US is insolvent, and the only way to keep this chucking along is going to be to expand debt faster and faster. Now we got to realize the last 2 years we ran a $3 trillion deficit. Janet Yellen screaming that we need $6 trillion for this coming year or massive tax hikes. So however you cut it, it's absolutely mission critical. The Democrats push this budget through. Otherwise, the economy falls apart right ahead of midterm elections. So I find that highly, highly unlikely. Best case scenario for a crash is a very short-term volatility event that's resolved by December to pass a budget. So that's what we're taking a look at. Now, most likely they pass a budget, come to terms, and we melt up into March, and then we can worry about the fiscal cliff and labor recovery by Q2, which is when I think we might have to see more stimulus passed, or again, record jobs growth. So now may be the best time ever to follow the high risk, high return strategy. I'm a huge fan of the PRO system. The second the stimulus passes, I'd anticipate Europe and Asia greatly outperforming, price of the dollar coming down, commodities rocketing higher, and again, more pressure to start raising those interest rates. So, okay, those are the key headlines. We'll see what the Fed tapering on November 3rd could do for markets. I believe Wednesday is when they'll officially announce their plans. And in general, I don't think the economy is ready to taper, even though the inflation is hot. So on the inflation front, they have gone overboard. But on the labor recovery, it's extra weak. There's a lot of uncertainty as to the budget being passed as far as next week goes. The GDP in Q4 has been crashing, and we've got a lot of uncertainties out of Asia with defaults in the real estate market. So we will see what Mr. Powell does come Wednesday. So the big question is, will he wait till December to taper? The FOMC minutes certainly said November or December based on economic data. If he does taper, what's going to happen? Are interest rates going to rise? And we get a growth to value rotation? That seems like the most likely outcome. Or will stocks crash, yields fall, and the dollar rise? That seems unlikely, because we've got to realize tapering just means they're going to slow down the printing press versus actually tighten. So the rate of change of printing is certainly slowing down. So again, we'll be ready. We'll probably increase our UVXY next Tuesday and then see how this announcement plays out. And the final wild card is the medicine for the global sickness. We have to use words that don't get censored. So I'm sure you guys know what that means. That means it's failing. Okay, it's absolutely not working. The hysteria over mandates makes zero sense. They're now pushing this to children. 70% of the deaths coming out of the UK had the medicine twice. Okay, so the likelihood of becoming infected is now greater if you're over 30 if you've had the medicine twice. Okay, now they're rolling out predictions that Pfizer will double sales next year. Why? Okay, because obviously they know this medicine, it works for about 3 months and then it falls off a cliff and actually seems to increase your likelihood of becoming reinfected. Furthermore, the data is now supporting that you will not get the robust long-term immune response even if you catch the real virus after taking the medicine. In other words, you are hooked on the medicine indefinitely. So very, very interesting when we look at the projections for Pfizer in terms of revenue next year. And it's also the 5th largest position in senators' stock portfolios. So it does not look like the sickness story is going to go away as I had hoped after this big wave we're anticipating comes in this winter. Now, how does this play into markets? I believe if we don't see a deal within the next 2 weeks, that the blue states will lock down to create a financial crisis to pressure the deal through. Because again, this is mission critical for the Democratic Party to get this stimulus passed. Failure to close a deal in December, in fact, I believe it needs to close within the next 2 weeks now, because the debt ceiling issue comes in December 3rd. Now, will McConnell give him another free bone and expand the debt ceiling again, like he did a few weeks ago, or is he going to actually pressure the Democrats to push this through? We will see, but that's what we need to focus on here. But it doesn't matter. We're ready for a short-term crash with UVXY, and I will up the ante on that position, most likely Monday or Tuesday of next week before Powell's announcement. Again, I don't think his announcement is going to create a stock crash, more likely a growth to value rotation, and he may not even do the tapering announcement Wednesday because of all the uncertainties in the market. Here's just a reminder, last time we got a significant crisis. And again, we had the whole world thinking we were going into a bubonic plague that would never relent. And you got this massive 1000% return in UVXY. Can we create a similar hysteria this winter? Perhaps. The market's much more leveraged now and ready to snap if you get enough people selling at once. So we will be prepared and hedged for that event. And the closer we get to the middle of November without a deal, the more hedged we will become. Okay, so here's some critical lines in the sand to predict problems before they occur. One will be DXY ticker going over 94.50. Now, just a few weeks ago, before McConnell threw the Democrats a bone, we had hit 94.55. DXY fell to as low as 93.50, and you saw your portfolio skyrocket up in value. Okay, today it's come back at 94.1. We actually have oil flat. It was down a tiny bit. We've got the dollar rising 0.8 against the euro and the TLT flat. So if we were to see the TLT rising, the dollar rising, and oil falling rapidly, that's the magic combination to predict deflationary shock, or in other words, a serious correction in stocks. But right now they're all just humming along flat, so nothing to become concerned about. Now, in general, I'm more worried about the TLT falling than rising. If the TLT is rising and the dollar and oil are trading stable, that just means the bond market's continuing to be unattractive, and it's going to force capital into stocks, commodities, and crypto, which is how we're positioned. So the TLT rising is really not our primary concern for markets over the next several years. So TLT going below 140 is going to create a lot of problems for the economy. The interest rates will become so attractive, people will sell everything to buy up these treasury products, betting the rates will go lower and crash everything around it. So TLT going below 140 is a big problem. Today it's at 147.32. Reverse repo just hit $1.5 trillion. So no reason to become concerned on that front. Okay, Brent oil falling to 75 would make me believe we have a recession underway. Only thing that would likely cause that to occur would be a failure to pass the budget or a significant global lockdown. Now we are seeing some of the European countries getting ready for new lockdowns. We've got this new variant that gets around all the medicine, all sorts of little headlines starting to form. But again, I think it will be politically motivated lockdown in the US that could cause Brent to crash below 75. Today it's at 83.57. So we're not worried about that. Okay, what about China? So China, we can look at the EEM ETF going below 48, or we can see their currency, CNY, devaluing. So today we have emerging markets down 1.8% at 50.75. So it's not near that critical level. It's been trying to make a new move higher, but again, it really needs a stimulus pass on the dollar to weaken for that to play out. China is now starting to aggressively print money and stabilize their economy, and their currency, CNY, today is flat at 6.4. So if we saw CNY against the dollar go above 6.6, we can say that China is devaluing their currency and become concerned. But again, they're just not. They just had record imports and exports. So at this point, there's no reason to become alarmed, and why we have not gotten defensive and tell you to hold your ground and stay allocated exactly how we are. Now, if you wanted to really just simplify life into one single indicator, if the price of oil doesn't crash, we're going to be very skeptical that a deflationary shock is coming in. Okay, so I think oil is going to go higher, the stimulus will pass, the dollar will fall, and our strategies are set to make some epic gains through Q1 of 2022. And we'll be looking at levels on the dollar to call a top in this exact setup, and then rotate into a more defensive play. So where would we want to call a top in this positioning? Once we see recent weakness of the dollar hitting 90 and going as low as 89 or DXY, that's probably when we want to start calling a top, at least in the short term, on our NRGU position, which has doubled just in the last month. So right now, the dollar is pretty strong relative to where it was just in May. And I think we will retest that May low in the near future. So hold on to your horses, no changes. Now, my core prediction remains that we have a slow motion multi-year rotation out of growth. Okay, reminder, growth is tech stocks. It is also cryptocurrencies, and it's long duration government bonds, TLT. And we're going to see money slowly but surely rotate to a higher market valuation into value, which will be your banks and energy companies. Okay, so that's how we're positioned. And the only thing that would stop that trend would be, again, government failing to pass stimulus, which I believe will occur. So we're not predicting that's not going to occur right now. All right, this is the chart to study. So 2002 to 2008, you get a beautiful melt up in energy companies. You crash the stock market in the dot-com bust, and you have this epic rotation out of tech into value. It lasted 5 years. Interest rates rose the entire time until it disrupted the real estate sector. Boom, you crash the economy. Oil goes falling fast with the energy companies. Government reacts faster this time. They're now going to double the deficit spending, and we're going to see interest rates rise all the way up till 2016. Energy companies have another epic run up. Now, once Mr. Trump came in, the globalists do not like populist policies. They do not like disrupting supply chains. And we can see they went into a quantitative tightening period the second he became part of the picture, which led to the big crash in 2020. So yeah, what were they doing? Quantitative tightening, selling bonds rather than buying them, and then raising interest rates. And so that's a recipe for crashing commodities. So again, we'll talk about when we think that could happen in the US and how we would respond to that. But again, right now they're just talking about slowing down QE. They're not talking about quantitative tightening, which would be selling bonds rather than buying them. And they're not talking about raising interest rates right now. So I believe we have epic returns ahead through 2023. 2023, I wouldn't be surprised if they try to get tighten policy to fight inflation after the midterm elections. If they try to do it next year, which the bond market's predicting, we'll show you that, you're going to have economic turn down right ahead of critical elections with a probably the least popular president in perhaps in history. I'd have to go back and study that more, but likely we're going to have very easy policy and a huge push to keep the printing and fiscal deficits rising through the midterms, which end in December of 2022. So NRG is just getting ready for a melt up here, guys. Now, when stimulus passes, I would expect EDC and EFO to outperform UPRO. And when stimulus is not passing, we're seeing the opposite. We're seeing American stocks dominate and foreign stocks have less of a return. And so just a reminder, last time we passed stimulus was December and February, and emerging markets, which is EDC, went up as much as 30%. European markets went up as much as 24%, while the US markets only went up 20%. And again, that's because US doesn't make its own goods and services. It buys them all overseas and ships them in. So when we're expanding debt, benefits foreign countries. When we're failing to pass new spending, we see a reversion, and that's what's been occurring this year. So the other big expectation when stimulus passes is for interest rates to rise and to pressure a rotation from growth to value. Here's just a reminder of what happened when interest rates rose. In yellow, you can see energy, in green went rocketing up, and in tech, the QQQ, it sold off in March. Now, the problem was the stimulus did not create a robust recovery, and we were still fighting lockdowns globally. So the stimulus wore off quickly, interest rates fell, energy came back down, and tech went back up. Okay, but what are we on the verge of doing? Passing more stimulus, hopefully continuing to reopen economies, recover labor markets. And so we should see a repeat of the growth to value rotation. Okay, so that's the big picture. Critical trade alerts coming up. You don't want to miss our trade alerts. Call John now to upgrade your free trial or your expired trial at 505-610-1334. Okay, so now what I want to do is look at some critical data here. So what we're looking at here is called the yield curve. And we're comparing today's yield curve with July's yield curve. And so this is what's happening globally. We're seeing what's called a flattening of the yield curve. So in other words, the 2-year bond has jumped, and that's a huge jump. So that went from 0.2 to 0.5. The 2-year interest rate is spiraling out of control and has doubled. And this is a phenomenon happening globally. So we've got Australia, Canada having big jumps. We actually had Bank of Canada end its QE suddenly, abruptly, and mentioning they're planning to do rate hikes. We've had weaker emerging market countries also following the same suit. But do they really lead the Fed? Not necessarily. Now, on the other hand, on the 20 to 30-year range, we actually had an inverted yield curve on the long end for a split second this week. The 20-year had a higher interest rate than the 30-year. So what's the market telling us? It's telling us we have some heavy-duty inflationary problems in the short term. And in the long end of the curve, it's telling us we have a low growth problem. So not good news. What we really want is this to be slanted like a ramp for a healthy yield curve. So this is not a healthy yield curve. So this is what's going to pressure the Fed to start potentially hiking interest rates and ending QE. But the problem with that is they have not recovered the labor markets to handle higher interest rates. So damned if you do, damned if you don't, problem coming up here for the Fed. So we'll have to just see what they want to do about this. Okay, this is the VIX futures, and we're interested in how big of a jump in price there is month over month. Bigger the jump, the more likely there is a volatility risk in stocks. And so we can see the biggest jumps are from November to December, and then from December to January. After that, it really calms down. So what are the critical risks? It's clearly the Fed raising rates, the Fed slowing down quantitative easing next week, and then the failure to pass a stimulus. Those two events are certainly hedge worthy, and we can see market participants are hedging November, December much more aggressively than other months. Now, if we're led to believe interest rates are really about to rise, I would believe the reverse repo would be falling. Okay, so it just jumped $100 billion. It's hard to even say that, $100 billion just in the last meeting. So from 1.4 to 1.5. I believe if this falls below 1 trillion, the writing's on the wall and that rates are on the verge of rising. And that will signal us to reduce exposure to tech stocks specifically. But again, it's not doing that. So we'll keep a close eye on it. Reverse repo is rising. That is bullish in terms of keeping rates lower and pressuring investors into, again, stocks, commodities, and crypto. Okay, so here's a look at the interest rates. You can just see how correlated this is. Interest rates start to go up. You get this parabolic move in NRGU. Interest rates come down. You get tech blistering higher. And you get this pullback in NRGU. So what comes next? I would say what we saw in December through March. We're going to pass stimulus. Interest rates are going to rise. NRGU is going to go way higher. Okay, Russell 2000 and the S&P 500 both had a jump. Usually the Russell 2000 has a tremendous outperformance to the SPY, so that's a little bit odd. People are pointing that out this week. So if we look at the chart in general, looking very bullish for Russell 2000. As soon as stimulus passes, I think every index breaks to a new high. So that's why I want to be careful about getting too defensive ahead of this. All right, here's been emerging markets since March. Again, this is exactly the time period where the dollar has significantly risen in value, rates have fallen, and we've failed to pass stimulus. What's about to happen? We're about to pass stimulus, interest rates are about to rise, dollar's about to fall. So we want to continue to be long emerging markets. And we do that with EDC in Pro. You have a little bit of exposure in Bootcamp Core with F and GU. Okay, Europe is heavy in the banks and a lot of great companies out of that EFO. And again, as soon as that dollar weakens and rates rise, this puppy will fling higher. And we have exposure to this only in Pro currently. All right, so we're comparing Bitcoin to Ethereum. They're trading in lockstep right now. No significant different returns. And those are our two large crypto positions using the Grayscale Trust, GBTC, and ETHE. Bootcamp Core has a big Bitcoin position, while the high risk portfolio has the large Ethereum position. All right, are we going to ever get a return out of gold and silver? They've been duds. Interesting, we've seen when Bitcoin goes down, gold's been going up. So really, really fascinating to see that. Central banks are loading up on this asset. It's just a much larger market cap compared to Bitcoin. So about 10 times the market cap in gold versus Bitcoin. It's definitely been stealing some of its fun, but they've been acting the exact opposite, which does surprise me. We have a Bitcoin, we have a gold position in our Safe Alpha portfolio, and we have a small silver position in Pro. So carefully monitoring these positions, and the outlook for these are better and better over time. If we believe there's going to be a crash this winter, it will likely be short-lived and used to push political stimulus through. The plays we like are UVXY, TMF, Treasuries, and EUO, the dollar. Okay, so we've been reluctant to bet on that when all three branches of government are controlled by one party. So I think at the end of the day, there's a greater probability they push spending through and can avoid a Christmas crisis. But if we get to mid-November and there's no progress, we're going to bet on a crash. We're going to do it safely with UVXY, TMF, EUO, and we'll still have some long positions on stocks. No position changes today. We're going to wait for next week, Anita. I'll probably get you to about 10% UVXY on Tuesday. And then later in the month, we can consider adding treasuries, the dollar, and going even higher on UVXY, just in general, what we're thinking. And that's if we're not seeing good news on the stimulus deal. Okay, we have a few specialty plays that have done extremely well since the crisis. So F&GU up 1,323% since the big crash. It's highly volatile. It has 10 US tech giants that get lots of call option buying on it, and has 2 Chinese giants, Alibaba and Baidu. So we've seen some of the assets in F&GU really get hit over the head. Amazon, Apple, Twitter, Facebook, all having a whack to the head recently, and Alibaba and Baidu. So huge upside on F&GU because all of these problems are temporary. We've seen nice returns in rare earth metals, REMX, up 222%. Tan has been up as much as 275%, but currently only up 183. That's solar. Uranium, I'm getting ready for a trade alert. I'll probably get Bootcamp Core or Pro into uranium next week. Nice sell-off we were patiently waiting for. URA, that's the only way we hit these CO2 objectives by 2050 is nuclear. Copper, massive shortages for copper for the rest of our lifetime. COPX, that's going to be a long-term play for us. And then we've got a government specialty play, MJ, which I think will benefit from the Build Back Better social spending bill that's coming through. So those are our specialty plays, which you have access to in our Bootcamp core strategy. And again, all very good long-term plays. All right, here's that dollar index. So we saw some massive gains when we fell from the 94.50 to 93.36. It's jumped back up, but big picture is we're likely going to test the 90 level, and that's when we're going to call a short-term top in NRGU and probably look at a treasury play. By then, interest rates should have risen significantly. And again, the catalyst for this is spending from the US government getting passed. Okay, here's that Chinese currency. You can see how strong their economy has been. And this is, their currency has been strengthening with the dollar strengthening. So very, very fascinating. Just see how strong the Chinese economy is. And again, if this were devaluing against the dollar, that would be reason of concern. Okay, we have reviewed the energy play. My 2 cents on the cryptocurrency space is you should be probably heavy duty in Bitcoin and Ethereum. Ethereum has a chance to exponentially outperform Bitcoin if lots of software applications are designed on its platform. Right now, the blockchain's just too slow and expensive to really develop anything useful. They're switching to proof of stake. So as soon as they do that, perhaps we see some more applications. So far, the only meaningful application on Ethereum is Uniswap. And Uniswap is really just a ripoff of Coinbase, which is great. So this is a great example of a successful software application on Ethereum. But for them to really succeed and demand this large $500 billion market cap, it needs to build a lot more successful software applications. So we'll see how that plays out. Bitcoin is deflationary and set to jet as far as I'm concerned. I don't see any significant problems for Bitcoin other than central banks tightening monetary policy, which will always be short-lived unless they can get a robust labor recovery. The outlook for Bitcoin is beautiful. So I like to hedge Ethereum with a large Bitcoin position, and I like to hedge my Bitcoin position with a large Ethereum position. There's one other hedge you should consider, and that is the competitors threatening Ethereum, which are Cardano, Solana, and Polkadot. And so they have been slowly but surely working their way up the food chain. Cardano, Solana, and Polkadot would go up 10 times in value just to catch up with Ethereum's market cap. So massive, massive outperformance opportunity there. We have a private equity offering called Rebel Dividends that does get you those important hedges for Ethereum that we don't offer in Portfolio Builder because you have to go set up real cryptocurrency accounts, which is really a lot more work and advanced knowledge. So that is my look. This Shiba Inu coin, someone bought $8,000 worth of this a year ago or so. It's now worth $5.4 billion, just hilarious. I'm not interested in these hypey schemes, but boy, oh boy, what a story. I'm sure this won't end well. So if you did play SHIB, good for you, but I wouldn't be myself and I'd be getting out. Remarkable that Dogecoin is still hanging in there. So too funny. We've still got the SEC case against Ripple. Looks like that should be resolved soon. Binance coin, I like Binance. I like the founder behind Binance, but I prefer to play the Pancake Swap, which is the DeFi built on, this is the DeFi exchange built on the Binance Smart Chain. And so when you hear that Binance is getting kicked out of all these countries because they potentially breaking security laws in these various Western countries, well, that's going to force people to their DeFi exchange, Pancake Swap, and they offer a 72% staking reward. So this is one of our larger altcoin positions for Rebel dividends, and how we're able to pull off a 1%. How long-term are these assets? You need to hold these for 3 decades to even think you're getting close to the maximum return. Okay, that's how long it's taken companies like Amazon and Apple and Facebook to really start to even begin to saturate their markets, and they're still growing at massive, massive clips that outperform every other company under the sun. So yeah, these are all very, very long-term positions, decades ahead. The structural problems in the global economy are not going away, and if anything, they're getting worse. They're getting worse and worse. And then our final hot play is Polygon. This is a layer 2 solution for Ethereum, and it also helps you get money between these different ecosystems. And actually one of the best performing cryptocurrencies in the last 2 years, the best outside of Shiba and Dogecoin. Okay, so that's my commentary on the crypto space. Just to look at the returns of some of these assets since we'll go back to this, let's find a low point. So we had a relative low at the turn of the month. We got Polygon up 90%, Polkadot up 68, Ethereum up 56, Solana up 52, Bitcoin up 51. The hedge that is potentially going to save your ass in crypto is NRGU. If interest rates go up, that means we have bond yields going up, and that's your threat in a growth play. NRGU is your hedge against that threat. So we're seeing both go up. Gotta love that. Cake flat, Cardano flat, and then a margin call, which means oil or commodities would lead the crash. You're protected with UVXY, down 31% on the month. Okay, so as far as the lockdown threat, this is certainly a threat. We're seeing the rate of change has been collapsing, but that rate of change has bottomed out, starting to pick back up. And the big picture is we're predicting there will be overloaded hospitals by the end of November, which is exactly when we need to see the stimulus passed. If not, expect lockdowns, market crash, and a big hustle to push spending through. If we get the spending through before the end of November, there's no political ammunition to do lockdowns. So if they push the deal through, I highly doubt they'll do any lockdowns, regardless of how overran hospital systems get. If they can pass it, we've got a clear coast to melt up from here, regardless of the hospital situation. If they fail to pass the budget, expect them to use this to help push a deal through. So just really that simple from that point of view. All right, so not going to obsess over that. Okay, if you look at the NRGU chart, I wouldn't do that. Instead of trying to use technical analysis on NRGU or valuations on that front, don't. Look at XOM, Exxon Mobil. This is the leader of the energy companies in the US. And if they're going up, then NRGU is going up. And so they beat on earnings today, and it's just a perfect setup for them. I won't be scared of our NRGU position till the dollar hits 90 or ExxonMobil goes above 96. And I do think in this cycle, Exxon's going to hit record highs. So it's going to take several years to hit the peak, and there'll probably be a temporary tantrum when interest rates hike, which we'll look at when that potentially could occur on this chart. So this is where they are predicting, based on interest rates, when there will be a tightening on interest rates. And so this is sooner than I anticipate. This is saying June of 2022, they're going to hike rates once, which may not be enough to cause problems. If we go to February, though, we can see there's a 30% probability of 2 rate hikes occurring. That will definitely do the trick. Okay, so definitely our cryptos do not want rate hikes. Nothing in the economy wants rate hikes. So that's going to be the key thing to focus on. All right, now we're looking at oil against interest rates. So we got rates falling and oil going up. What's going to happen if the Fed slows down its purchasing? Will oil fall to yields, or will yields rise to oil? So I would say the yields will rise to oil at first. And then if we pass stimulus, the yields rise and oil goes significantly higher. The energy shortage is just not going away. The only way to really avoid it would be to crush the demand for energy. So good luck. I just don't see that happening anytime soon without global lockdowns. Lockdowns would definitely do the trick. Copper futures, Dr. Copper, continuing to rise, a little bit of a pullback here. Lumber futures had been rising, and again, we're seeing a weakness. All of this is due, in my opinion, to failure to passing the stimulus, plus Bank of Canada ending QE and announcing rate hikes. So again, second we pass stimulus, I do think the inflationary play continues. Baltic Dry Index, nice sell-off here, showing some slowdown in the inflationary pressure as well. But we've seen this many times before, only for it to leap higher. Okay, here's the bond market. Long term, we believe these rates are headed to zero because we're at a debt to GDP over 100%. The US is trapped, it's insolvent. Its only solution is to print more money and keep suppressing these rates through quantitative easing. Second, it fails to do that, we've got a huge problem on our hand. I will be aggressively buying treasuries for our clients once we break that 2.4 level. I think the economy would completely collapse if we got anywhere near 3. And so we'll be aggressively buying it after we break this critical level here that we recently topped out in. And when did we top out? Right after big stimulus. Unfortunately, the stimulus did not recover the economy in terms of labor. And so then rates came back down. So we'll see how this stimulus comes through and the effects on interest rates. Gold to copper ratio gives you a good feel for what could be coming for this cycle, which is higher interest rates, higher copper prices, and an underperformance in gold relative to copper. Okay, the bond markets we care about are TLT, J&K, and LQD. This is what funds junk bonds, so Russell 2000 investment grade bonds. So that's your top tier US corporations like Apple and Microsoft. And then the TLT is what funds US government. If any one of these three are falling rapidly, it tells you we've got problems in credit markets and watch out. But right now they are not doing that. This is where we track Janet Yellen's issuance of debt. I'm not worried about how much she wants to. In fact, I'm worried if she doesn't issue enough debt, then we're going to have bigger problems. So I'm not worried about any amount of debt coming through at this time. Non-farm payrolls has collapsed over the last 2 months. I don't think we're going to get a good print in October due to mandates. And then I think the next wave of the sickness hitting through will slow down jobs growth all the way into February. So I'd expect jobs start to pick up into March, most likely. So will the Fed taper or hike rates with a dead labor market? Probably not, but we'll have to keep a close eye on that. Inflation did run flat month over month. I think it's going to start picking back up due to energy costs and rising labor wages and rising rent costs. Bank loans are growing. That's what we want to see for how we're positioned. Consumer credit is continuing to expand. Also what we want to see, retail sales did jump again, so still strong consumer. Retail sales hit a record high, no contraction in that yet. Job openings have fallen slightly, but plenty of jobs for the unemployed. Will they go back to work? The producer price is continuing to remain elevated. We've already seen this crush the profitability of Amazon. It's really just their data center that carried Amazon through this earnings. Apple's having supply issues. So we're starting to see the inflation start to eat away at the profits of corporations. So they're going to have to start pushing these rate hikes, or these price hikes through, and we'll see if the consumer will keep buying at the higher prices or if it's going to slow down consumption. But so far, no signs of the consumer weakening. Initial jobless claims cannot get below 280. So we will see if that can break to a new low next week. Earnings are rising. People are getting higher pay, not as fast as the inflation yet, but again, this is helping to sustain the inflation story. Now, to really change our outlook on how to play the markets, we'd want to see this jumping. So this would be labor force participation. If that were to rise significantly long term, it would actually be very bad for bond markets and stock markets. So yeah, that would be, it's funny, if we get everybody back to work and heal the economy, the financial markets would be ripped apart. But is that going to happen? I highly doubt it. Corporations are hiring robots and government wants to pay to stay at home. That's really the general theme, probably for the rest of our lifetime, which means more and more deficits and more inflation. So that's how we're positioned. Balance of trade hit a new low. This is going to weaken the dollar. Just need to pass the next bill and our portfolios are set to go significantly higher. This is a new print and personal income did fall a little bit. So again, there's a lot of people who are losing those benefits. About 4 weeks ago, they need to get back to work. Apple had a bad earnings this week and a little bit of a sell-off, but this is temporary. Nothing really in the way of Apple. Tesla doing all its shenanigans. It sold some cars to Hertz and then bought Hertz's bonds with the sale and ripped higher to new highs. Second the stimulus passes, I would get out of Dodge for Tesla because I think rates will rise and that will freak people out. Also, I believe Elon might be incentivized to start selling some shares here soon. So fascinating chart there. This now is a significant risk to the general market because it's such a heavy weight. 5% of the NASDAQ, 2% of the S&P 500. Kathy sold her Tesla way too early, poor thing. And another significant risk to the market would be ARK tanking. Again, none of these guys are tanking. Tencent, big Chinese software company that we're worried about if it were to fall. It's not stabilizing here. Alibaba, same thing, stabilizing. Samsung starting to stabilize here. Toyota getting ready to rip to a new high. So again, just nothing to really freak out about right now. China's PMI has gone back to positive territory. They are now printing money rapidly. Their imports just hit a new high. Their exports just hit a new high. European PMI still in positive territory, although slowing. I got protests all over Europe over mandates. The Fed's balance sheet will grow to over 9 trillion if they start tapering next week. So we'll see. I think there's a chance they may delay that and appease the markets until we pass stimulus. We'll see how that plays out. European Central Bank continuing to grow as well. All right, let's go ahead and hit the news feed. During periods of structural inflation, energy often comes out on top while consumer stocks slump. And so you can see some of these inflationary periods, and in red, you can see energy just dominating in all these time periods. That's how we are positioned. Zuckerberg and Elon Musk have exact opposite visions. One wants to go inwards with the metaverse, and one wants to go outwards to space. Mohammed El Arian says inflation surprise in the Eurozone came in at 4.1 compared to 3.7. So how do you kill inflation? You hike interest rates and then you crash everything. Apple's supply issues are temporary, so buy the dip, JP Morgan says. We're starting to see some fear headlines about kids spreading the disease now, which is total BS, just for the big pharma to make more money. Little lockdowns starting to happen here and there in Asia again, and Europe talking about it. This is a joke, feta cheese instead of meta for the new Facebook name. From the same people that gave you Operation Iraqi Freedom and Affordable Care Act, the caveat emptor, Treasury Secretary Yellen says the spending bills will be anti-inflationary. All that I do not believe is true. Elon Musk says he's thinking about starting a new university, the Texas Institute of Technology. It will have epic merchandise, universally admired. Growth to value rotation, looking at how this could play out. So 2000.com bust led to a 10-year rotation out of tech into banks and energy companies. And here we are at these ridiculous tech valuations relative to value rotation. So again, I think same thing's about to occur. We'll see if we need a stock crash to get there or if it can happen without that occurring. Again, it's all going to be on the stimulus. We got Jim Bianco pointing out that wage inflation is here if you think that's what's required for long-term inflationary pressure. Okay, this is a chart comparing the volatility of stocks relative to the volatility of bonds, predicting a volatility event. Now, we're more worried about interest rates rising than falling because that's what would pressure people to sell tech and buy bonds. So at this point, not freaking out, as you know, but we will add to VIX next week ahead of potentially a policy error by the Fed. Raoul Pal is irresponsibly long Ethereum and sees his play for 6 to 9 months. This little chart just shows you, says, originally that the medicine is perfect and completely protects you. And then by the end of it, it's talking about how it stops working, and then it says, oh, it doesn't stop you from dying. And so the medicine's not working as advertised. We'll just leave it at that. Central bank has injected 1 trillion yuan into the financial system in 8 days. So the central banks like to take turns printing money. Chinese stocks are underperforming the world for a 9th month in October. That's the longest stretch since 1993. And again, I believe that is about to end. I'll probably be selling 1 share of UPRO to add to EDC for Pro in next week's trade alert, or soon as we think that stimulus is on the verge of passing, and expect EDC to scream higher. JP Morgan's making a similar call to be long emerging markets and commodities with the same basic outlook. I've been telling you that we're not going to get too tight with monetary policy ahead of midterms. This president's very unpopular. We'll see how this plays out in midterms. But now the 5, and if he loses the African American community, that's going to be a big problem for Democrats. So we can see in the hip hop section, Let's Go Brandon has now 5 of 5 spots. In the top 10, it has 3, including the top 2. If you go look at any pro-Democratic Twitter feed or YouTube channel, it's dominated with comments similar to Let's Go Brandon. So we'll see how this all plays out in the midterms. The CryptoPunk NFT is just nuts. This sold for $532 million or 124,000 Ethereum. Here's the artwork. So it's just, I guess, a bunch of billionaires who are trading these around as art. Again, here's the infection rates per 100,000 coming out of UK, where we have good, clear data. And just simply put, there's a higher infection rate for anyone over 30 who has had the medicine twice. Clear cut. Just very clear cut data. Nothing to argue about. Which is why I think we're going to have hospital issues this winter. Apple's drained its cash by $100 billion over the last 4 years, though they're still sitting on $66 billion. Facebook to start trading under a new ticker, MVSR, starting December 1st. So if you want to see what is envisioned, is go rent the movie Ready Player One. I think that's exactly what he's envisioning for Facebook, and it becomes the most valuable company in the world in that movie. Great movie. And yeah, I see that. I don't know if it'll become the most valuable company in the world, but I see what he's interested in pulling off for Facebook. Temperatures across Western Europe are set to fall below average levels next week. So again, the energy crisis is just getting started. And yeah, they failed to vote last night because Jayapal told them, no, no, no. Hold the line, hold the line. That's what the progressives are saying. Now here's some nonsense from Jayapal. Elon Musk, who made $36 billion in one day this week, would owe just under $8 billion under my wealth tax proposal. So they want to tax unrealized gains on stocks. That would be a recipe to collapse the stock market very, very quickly. So there's no chance that will happen. Here's a look at the commodity demand out of China. Just massive cement, copper. So they're printing money right now. It's going to keep everything alive here for the reflation play. What were they doing? They're taking advantage of everyone else printing money, all this incoming income to pop bad bubbles, and so they cleaned up their economy. I don't see what's occurred with the underperformance out of Asia as a problem in the long run. So if anything, more bullish on Asia now than I was previously. Okay, very good. So we're about to transition into the content only for paid members. So this is the end of the video you can catch on YouTube if you're lucky with our remarketing ads. So this is where the video ends. If you're not a paid member, you're going to miss out on the exact trading formula. Call John at 505-610-1334 to upgrade and get our critical trading formulas. And more importantly, if we're going to crash, I'm the one who's going to predict it and tell you how to protect your wealth and make a lot more money on the downside than you would on the upside. So very good. Let's go ahead and switch gears to paid content now.